India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Monday morning, bright and early. Lots of stuff to react to. More local than global, I dare say. But there is, that global overlay as well, which I'm not very sure is as positive. So let's get the ball rolling. I'm Prashant, with me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning Nigel, morning Prashant. Prashant, with Donald Trump being the president-elect, can you think there'll be less global stuff to talk about? We'll always have a headline. I have one, which I'll get to in just a bit.
Well, plenty to look forward to in this week itself. We'll have the jobs data coming out of the United States. End of the week, you'll have the RBI decision. And the big one for us here at CNBC TV18, our birthday celebrations as well. So plenty to look forward to all through the week and on the weekend as well.
What's on the weekend?
The India Business Leader Awards.
Oh, Saturday.
Yes.
Oh, I thought it was, okay, of course. All right, well, let's just quickly get the ball rolling and tell you what you need to know. And, usually, of course, I start with the U.S. market session and what happened, etc. But, U.S. largely, because Thursday was a market holiday, Friday was a shortened trading session. It wasn't very much to talk about. So let's start with the GDP numbers. We got a big miss, a bit of a shocker. And if you are on social media or on X, Twitter, etc., hashtag GDP shocker was trending, right? And it was a bit of a shocker because growth fell to the 5% handle. And third quarter numbers have come in at a 7-quarter low. And I think generally, if you looked at corporate earnings expectations, etc., and we sort of put that piece out towards the fag end of the second quarter, which showed that 66% of companies on the NSE 200 which have reported have seen earnings cuts. It's the largest downgrade since 2020. And so the market, from a stock market perspective, a lot of it perhaps was anticipated. It's just that while the direction of travel was clear, which is that the growth will slow down and perhaps numbers will show that, the fact that you are now 5 point something as far as the numbers concerned on GDP, I think that was really the shocker. Now, there is widespread acknowledgement that there are two factors responsible: slower government spending, and again, and market guess, etc. And we've kind of debated this and sort of talked about this quite a bit. That is number one. That perhaps will pick up in H2. It must pick up in H2. And the second, of course, is bank credit, which has slowed down quite a bit. Which is, these are the two factors which has led to slowdown on the government spending. Number one, and second, bank credit, which is, of course, directly related to personal consumption, which has also come off quite a bit. And both are expected to pick up in H2. So that's essentially what I want to put out. Now, just a couple of more points. If you read through and we put this out, what the street expectations from what the RBI will do, should do, etc., that is on the 6th of December, on Friday, that has gone up sharply. Not in terms of an outright rate cut, because, maybe their hands are tied because of CPI, etc., but maybe ease liquidity in the system, a CRR cut, etc., etc. We'll see. But the RBI itself will perhaps lower their full-year growth guidance, etc. But I think this now becomes the big talking point all the way into Friday. But if you're just trying to sort of extrapolate the sharp slowdown to market and what the stock market will do this morning, I think you need to be careful because you've got, as I said, the street already knew that growth is slowing because of the corporate earnings, which have disappointed quite a bit. If you look at full year FY25 Nifty earnings or, the NSE 200 earnings expectations, they're all in the single digits now, 9-10% kind of growth. The bigger thing, of course, which I think we'll talk about, and Lata will join us a little later as well, is that nominal growth is also now slowed to about 8%. Remember, that is important for corporate profits, not real growth, but nominal growth, and that is now tracking at about 8%. I'm sure we'll hear more about this. Just one point from the global arena, and this, of course, as Surabhi was pointing out, is Donald Trump and his tweet early Saturday morning for us here, in which he clearly pushed back against the de-dollarization, which is being pushed forward by countries like China the BRICS countries essentially. And he threatened 100% tariffs on sort of countries which are part of BRICS. BRICS, by the way, is not just, the earlier group of countries, 5 countries. I mean, they've extended membership now. But he's threatened 100% tariffs on countries if they sort of try to diversify away from dollar as a financing currency or a reserve currency. Again, I mean, what does this do? I mean, I think for the rupee, maybe it is a bit of a negative because the rupee largely, in India largely, was seen as a non-tariff sort of, a currency which is not really hit by whatever Mr. Trump wants to do in terms of tariffs, etc. But him sort of very clearly putting this out there maybe increases the risk premium for BRICS currencies not in focus as tariff trades, especially currencies like the INR. We'll see what the rupee does this morning. But I think what it also shows is the willingness of Mr. Trump to use tariffs as a tool to get what he wants. I mean, I think that has been clear, but this kind of just sort of showcases it, and he's not even taken charge as of yet. I'll just get straight to levels here before we go any further. I think on the Nifty, we need a break above the high, the recent high, which I think we've been knocking at for 5 days in a row now, 24,351. We're about less than 200 points away from that. And of course, above that, we look at the retracement levels, etc. Support levels will come up on your screen. That stands at about 23,873. For the Nifty Bank, levels will come up. Again, similarly, I mean, the recent high and the recent low are those levels. Resistance stands at 52,760 and supports come in at about 51,759 or so. GIFT Nifty will come up on your screen. I checked about 60 minutes ago. I think it was indicating a slightly higher start, 30 points higher. Surbhi.
Well, Prashant, you've pretty much covered it, all the points that I was going to talk about. But just to go into some of these details over here, if we just look at some of the additional data points we're getting from the Asian region this morning, the PMI numbers from China are looking very, very good. Both the Caixin PMI numbers, manufacturing numbers, as well as the official manufacturing PMI from Asia. The numbers are above expectations. The expansion is continuing in November, so that's good news. And some of the Asian markets are continuing to move higher. Remember, of course, US markets also managed to close off positive in what was a shorter sort of trading session on Friday because of the Thanksgiving holiday. So global equity markets are going about their business. Now, let's just put the Trump tweet in focus. The tweet where, the US president is very clearly talking about, a bit of a deterrent to the BRICS, saying that, no one should think that there can be a BRICS currency replacing the dollar. He's saying that any country that tries this should wave goodbye to America, so on and so forth. They can go on and find another sucker. So it's a very colorful tweet that he put out over the weekend. And we'll see if there's any sort of a major reaction in terms of the dollar moves. We're not seeing that much of it tonight. Coming to the GDP shocker, 5.4% versus estimates of 6.5%. Now, the question is how much of this is in the price, because corporate earnings have been talking about this in any case when we know there's a corporate slowdown that is underway. But even then, having said that, the expectation was about 6.5%. You've come in at 5.4%, and we'll get into the reasons why. It's largely an industrial and manufacturing-led slowdown. There are 3 key questions that this data is throwing up. Number one, is the slowdown transient because of monsoons and lack of capex, and government spending, etc.? Will the RBI relent earlier than what the market had in mind? No one was really looking at a realistic possibility of a rate cut coming this Friday, but is it on the table? And number 3, will we see more anti-dumping duty action? Because, you've heard this on the channel, sectors like steel, sectors like solar glass crying out for more protectionism. And tell you what, the CEA notes this. In the press conference, he did mention that there's a lot of dumping of specific commodities and industrial goods happening in India. So will the government take more action? So let's watch out for some of these sectors. These stocks could be in focus as well. The 10-year bond yield ended Friday at about 6.775%. So let's see what the bond market's immediate reaction is at 9 o'clock. Will the bond market now start factoring in a rate cut as early as Friday? And that will, of course, have a bearing on how bank stocks are doing today. So watch for banks. On the FPI flows bit, numbers are still very, very patchy, one would just have to say. Now, look at what happened on Friday. Remember, on Thursday, we said it's an expiry impact, and therefore we had a massive sell number. But Friday's number was not offering any additional confidence because they were still selling off about 4,400 odd crores. Domestic institutions were net buyers. The reason we had a nice pullback on Friday is because of the DII buying. Look at the DII number, 5723. So nicely offsetting the FII sell impact. That was Friday's picture. But I mean, if you pull back and see what's been happening, yes, November has seen a slowdown in the intensity of FPI selling. One would have to take that kind of, on the table as well. 90,000 crores of selling in October. In the previous month, it has come down. And finally, last but not the least, we're starting December. So will Santa Claus come to town? Santa has missed most of the Asian markets. It's been all about American exceptionalism. So as I wrap up, let's put the numbers on the table. I mean, can you imagine the Russell 2000 has rallied 10% in the month that's closed in November? So will these trends, the strong, outlook on the US market, will it continue in the end of the year period as well? Contrast this with Asia. We're flat. So are markets like Japan. But I mean, it's better off than something like a Hong Kong Hang Seng, which is down 5.5%. Kospi is down 5% in November. So Asia has been absolutely left out in the cold. Let's see if Santa decides to give us a bit of a cheer as well, Nigel.
Well, that's right. And the GDP print was a bit of a shocker, right? But it could make the RBI, force them to do some kind of action. Maybe not a rate cut, but maybe some kind of bond purchases, or maybe, in fact, a CRR tweaking is something that we could see. So because of this poor print, maybe you'll see that RBI may have to force his hand. That's, I think, what the street will be working with from here on. The resistance, though, comes in at those levels that we did hit last week, which is around 24,350. Positioning, the FIs, they continue to remain net short. 67% of their positions are on the short side. Even in absolute contracts, the FIs are net short, while the clients are net long. And that has been the case for the last couple of series or thereabouts. Moving to the options data then, we have two strikes that were fairly active. 24,500 call and the 24,000 put. Both of them were fairly active in Friday's trading session, which gives us the broad range we're looking at. And that perfectly tallies in with what we saw in terms of a low on Friday and we saw in terms of resistance for the past week itself. So the low that we saw on Friday was at around 23,927 approximately, which tells you that 23,900 mark becomes crucial on the downside. On the upside, you'll get more confident once we get past this 24,400 mark, because last week we went numerous times to this range and then we saw some bit of a resistance. The Nifty Bank had a decent session in Friday's trade. It ended mildly higher. But in fact, if you're looking at levels, reference points on the downside, I think this 51,500 mark becomes important as the first level of support. So that's going to be the crucial level. 20, 50 and 100 EMA up for you on the screen. Looking at two stocks. Home First, it's been under pressure in the last 1 month or so. It's relatively underperformed. And now we have a large trade that will take place. Close to around 15% equity gets out of the way. So that's the first stock I'm looking at. After it starts off in the red, let's see whether or not there's a recovery. Point number one. Point number two, we're looking at Adani Ports. They had an investor meet. And you had Nuvama that came out with a note. They have an aggressive price target out there because of the guidance that's given by the management. So keep an eye out on both these two, Home First Finance as well as Adani Ports.
All right, Nigel, thank you very much for that. So that is essentially the setup, the levels, and some of the stocks that you need to keep on the radar. Now, let's bring in Lata with her editor's take on the second quarter GDP numbers and to sort of really contextualize the numbers and the road ahead. Lata, good morning.
Good morning. Actually, I won't go through the details of every number, but what is relevant going forward and for the markets. What really led down the GDP was the mining and manufacturing numbers. Now, Nigel will tell you that most of the mining companies already showed that because the base was very positive margins. And because of that, it was very adverse margins in Q2. And that showed in the economy as well, even in the non-listed stocks. So the base actually turns positive when you come to Q3. You don't have such an adverse base. That itself means that growth will not be that much impacted. The other factor that has pulled down from the expenditure side is investment. Now, investment, we were not doing very well on consumption for the better part of the last 8 quarters, but government capex was clicking. It didn't click in Q2 as well, which was a shocker. That's again why economists went wrong. We got the fiscal data as well for October. The government is still 15% lower compared to year-ago levels. And even for the month of October, it is about 9% lower than what it was in October of 2023. They will probably start off on a frenzied level to do the capex. So those two, again, can be positive. And as everyone knows, Kharif and Rabi have both been positive. That also can spur consumption, which is okay at 6%, but needs to do much better if you need a 7% growth. So chances are that a 7% second half growth cannot be ruled out, and markets may actually take that into consideration. But remember, nobody was prepared for such a poor capex and number from the government in October as well. That data also came on November 29. So I think some disappointment on that. Can you really catch up that 15% fall in the next 4 months? I mean, you can have doubts over that. The other point that the market needs to note is that it's very difficult for the Reserve Bank to cut when the last available inflation number is 6.2. Their mandate is 6. So how can you cut when you're above the mandate given to you in terms of inflation? The expectation is they might do a CRR cut because there is a liquidity problem. You know, every time the RBI is selling dollars, and they've sold like, what, 60 billion or thereabouts, they're actually withdrawing cash. You sell dollars, you buy it with rupees. So that also means that the CRR cut is likely. Now, what happens for a repo cut and a CRR? A repo cut is bank negative because all their loans are linked to repo, or many of their loans, what you call the EBLR, external benchmark linked loans. That has to be priced lower, but it takes time for deposit prices to fall. So a repo cut is bank negative. A CRR cut is bank positive. What is a CRR? Suppose you have 100 rupees of deposits. On 4.5 rupees, you cannot make any money. You have to keep it as cash. Now, instead of 4.5, if you have to keep even 4/4 or 4 rupees as cash, the other 50 pice, you are able to charge 8%. Until now, you were charging 0. So that money actually becomes available to the banks. So my sense is today the action, if the majority in the market, and that's what I got when I polled economists, a CRR cut and not a bank rate, a repo cut, that is actually bank positive. I would want to see if the market endorses that view. On the negative side, I think FIs will be terribly disappointed because 5.4, yes, some of the disappointment was known, but I don't think 5.4 is in the price. So FIs could continue their selling. Remember, they started selling in October when the results started disappointing. They started selling in November only because of Trump and the positive and the possible upheaval. So my sense is that there is still a negative coming from the FIIs and accelerated selling. And you can see that in all the numbers that will come up for you, all the foreign brokerages. Nomura, Goldman, Citi, okay, ISEC, Kotak are Indian brokerages, but the string of foreign brokerages who have come down from a 6.7 to 7 range, they have come down now to a 6 to 6.3 range. And that will tell.
Sure. All right, Lata, thank you very much. So that is, of course, the big story of the morning. Let's quickly move on. We've got the equity calls of the morning coming in. Mahesh Nadudkar of Jefferies says weak 5.4% GDP growth for the September quarter is not surprising as corporate results were already implying weakness, but continued weak government capex in October certainly surprises them. He says a combined impact of slow government spending and a sharp decline in bank credit growth is a key reason for the current slowdown. He believes that both should reverse soon, which should aid growth. He says a much tighter fiscal for FY25 is on the cards, which is driving yields lower. He says a possibility of a CRR cut goes up.
Okay, well, that's Mahesh, and we'll get you a lot of more views through the course of the day. Arvind Sanger is Managing Partner at Geosphere Capital Management. Arvind, good morning. Good to have you with us here. Thanks for waiting. How much of this GDP shocker is in the price, Arvind?
Well, look, the GDP, we've been saying for months now that the economy was showing signs of a slowdown, and we were seeing it, forget before the earnings came in. We could see it in as varied data as some of the auto sales, CV sales, FMCG sales. We could see it even in government tax collections. All of those were giving us sign, even electricity demand. All of these were showing signs of a stress in the economy. And then the earnings numbers. So for some reason, the economists, I guess, were a little slow. So I don't think it's a big shocker. But I think it just raises the question, what does RBI do? And what does the central government do? We've talked about capex numbers continue to disappoint in October. We'll have to see. I think November is already over, so I'm not sure if they had time enough to respond. So we've lost 2 months already of the December quarter. So it'll be interesting to see what happens from here. The question, you were raising the question, or Lata was raising the question about FII selling. My question is, how much are domestic investors impervious to economic fundamentals? Is this a TINA market where there is no alternative? That's been the reason why money has been flowing in. If there is one risk I see in the market, it is domestic retail investors waking up and smelling the coffee and starting to worry a little bit. But otherwise, I think the economic bad news is not going to get any worse from this GDP growth, but it doesn't mean that it's going to be a V-shaped rebound.
Okay. Hi, Arvind, good to have you on. So the question really here is it going to be another big dampener for the equity market, or we've kind of heard this story before in different parts? We've all been through the Q2 season, right? It's been there. It's so evident. But could this be a fresh negative, or maybe a positive if we suddenly start expecting the RBI to move faster? What does this mean for equities?
I think RBI moving faster is a positive. I think to the extent that the central government moves faster, that's a positive. But to the extent that there are some tariffs introduced on steel and other imports which have been flooding in, that'd be a positive. So I think, yes, it could turn out to be the prodding that the system needs to take a more urgent, but on the other hand, you have, MFI slowdown, you have RBI still cracking down on a lot of unsecured loans. So, there are a few headwinds that are not going to go away. But on the other hand, there could be some signs of positive. So we'd like to see more of a concerted effort to get the economy out of the ditch. And that, I think, would be a positive for equities.
Hi, Arvind. Morning. Good to see you, Vin. So what are you factoring in then? That rate cut, the repo rate cut comes in only next year. And in the near term, we see some tinkering with the CRR or OMO purchases. Would that be the way to work with? Near term CRR cooling off, OMO purchases, and maybe that rate cut now is assured come the February meeting.
Yeah, all of those, I think, are the central case. Those don't get us, pounding the table bullish. I think we'd like to see more action from the central government in the shorter term. And obviously RBI, taking a little bit of a, easing in terms of CRR would be helpful. But I think, if the December quarter, fiscal third quarter numbers are shaping up to be also similarly disappointing, like the September quarter just went by, then I'm not sure there's a great rush into the market with both hands grabbing stocks. But I think patiently buying into what hopefully is the trough in what I call a mid-cycle slowdown. If that's where we are, then patiently buying into this is what we're looking for, and hopefully we'll get the right signs from both RBI, but also from the fiscal side, and some of the import tariffs and other things that might be helpful in the short term. But the global cues are also something to watch in terms of President Trump's somewhat unconventional and very unpredictable policy. And while that's not as big a risk for India as it is for other much more U.S. export-dependent economies,
yes.
But India cannot take its eye, completely off the ball on that front because, President Trump is somewhat more non-discriminatory in some of his possible actions.
All right, Arvind, we'll leave it there. Thank you very much for joining us. It's a pleasure and good chat as always. We'll take a quick commercial break here. We're going to come back in just a bit. Lots of stock-specific action to track as well with our research team. So our top 10 segment on the other side, we're looking at Aster DM, TVS Motor, Maruti Suzuki, Coal India, Greaves Cotton that are on our radar on the back of positive news flow. We have Cipla, Hero MotoCorp, Hyundai India, RBL Bank and Home First Finance, which are stocks which are likely to open in the red on the back of news flow. That's coming up.
Welcome back. Well, yes, there are global cues to focus on and that big GDP number, but there are enough number of stocks, lots of news flow over the weekend. So let's straight away get to it. We have our team standing by with the CNBC-TV18 list of top stocks to watch this Monday morning. Hi, guys. Good morning to all of you. Let's start first with Cipla. Nimesh, morning. We're expecting a block, some equity coming in the market.
Oh, yes, sir. So it's a large block. 1.7% is what the promoters are looking to sell via block deals. It's a certain part of the promoter family who are looking to sell this block. The offer price is at a 6% discount to yesterday's Friday's closing price, but it's a clean out trade from a certain promoter. So 1.7%, the deal size is close to 2,000 crores. I guess the stock may react negatively because it's a dip discount of 6%. But because it's a clean out trade, the execution could be important, and you might see a bit of a recovery after the block deal. But to start with, a 2,000 crore block in Cipla, that will get reflected in the institutional data as well in today's market.
Okay, thanks a lot for that, Nimesh. Well, let's hop across to Sudarshan. Sudarshan, how are the auto sales numbers?
So, normal auto sales are giving a mixed signal, while two-wheelers continue to remain on a strong footing. In the four-wheeler space, passenger vehicle segment was led by SUVs, while commercial vehicle segment remains a drag. So, we'll start with TVS Motor. Company has reported better than estimates. It was led by exports and electric vehicles. Total sales were up 10%. Electric vehicle sales have increased 57%, and exports too have risen 25% year-on-year. Coming to Hero MotoCorp, wholesales have missed estimates, but retail remains healthy, and there is a huge gap in wholesales and retail sales. Retail sales for the month of November are at more than 9 lakh units, while wholesales for the month of November have come in at 4.6 lakh units. The reason I'm going with red for Hero MotoCorp, because of a decrease in wholesales. Total wholesales were down 6.4%, and motorcycle sales have slipped 4%. Coming to Maruti Suzuki, I'm going with green. Sales were a minor beat to our expectations, and it was led by SUV segment. SUV segment was up 20%, and compact segment was down 5% year-on-year. Hyundai India, exports have dragged overall sales, and domestic sales were down 2.4%, and exports have fallen 21%. So overall, mixed trend continues to remain a trend. Mixed trend remains for auto segment in the month of November.
All right. So thank you very much for that. We had the, I should start with saying we told you, and then now it's news. But Aster DM and Blackstone's hospital company, Care Hospitals, is merged. They're coming together to form the second largest hospital company in the country. Vinny is standing by with details. Vinny, morning.
Good morning. Absolutely. This was a CNBC news break that was confirmed. We had Rachna who broke the story a few days ago. And Aster DM, Quality Care India, they are merging. They will become among the top 3 hospital players in the country. So this is a big merger that we're watching out for. Now, obviously, this will give them a lead in terms of scalability, also coming in for the central and south India, where they have a major of their hospitals coming in. Swap ratio that is decided for this deal is for every 1,000 shares of QCIL, the shareholders will get 977 shares of Aster DM. Other than that, this deal is going to be EPS accretive. Margins are expected to see an uptick of around 200 basis points over the next few years as well once this merger is done. And because as of now, what we're seeing also, the return on capital employed expected is to be at around 18%. Aster currently is at around 16%, so improvement in return on capital employed. Brokerages are also talking, and they are also quite positive on this deal coming in. Axis has raised the target price to 575 rupees per share. Elara Capital maintaining their target price at 521 rupees per share. An interesting merger, a lot of synergies, brownfield, greenfield opportunities in terms of expansion, revenue synergies that we're expecting to come in for Aster as a merged entity with QCIL, and that is why we're expecting a green on Aster DM today.
Okay, Aster DM in focus, and we will be talking with the management in just a while from now to talk about the merger and what the real synergies are. That's coming up at around 8:35 a.m. Thanks for that, Vinny. Let's move on. Nigel, Coal India, what's the news?
Well, there's a mild positive, that's coming for Coal India. They've approved the revision of add-on price of coal in the Rajmahal area of the eastern coal fields, which is one of their subsidiaries. It's revised to around 700 rupees per ton from around 450 rupees per ton. This means that the additional revenue that they'll get is around 300 crores. Looking at a Phillip Capital note earlier today, they are saying that if all of this flows to the bottom line, then the EPS could move up by around 0.7% or thereabouts. So mild positive is what we're seeing for Coal India this morning. But moving to RBL Bank, Ritu joins us to help us out with more details that came in post-market hours. Ritu?
Well, Nigel, good morning. We're going with a red for RBL Bank because RBL Bank and Bajaj Finance have decided to mutually stop the issuance of new co-branded credit cards. And that was a huge area of dependence for RBL Bank in their credit card portfolio. And therefore, this is expected to be a medium-term to short-term negative. Now, RBL Bank will continue to service the existing portfolio of co-branded cards with Bajaj Finance, which is about 3.4 million. But this number has been coming down. Their co-branded credit cards with Bajaj Finance are now down to about 37,000 as of September, down from about 1.26 lakhs, which is last year. Now, keep in mind, RBL Bank over the last 18 months has been trying to reduce this dependence because of the changed rules of co-branded credit cards. This was, along expected lines from about 65 to 70% cards being originated through this partnership. It's now down to about 36% as of the second quarter. So naturally, the brokerages are not very, positive on the news. They believe this could, constrain RBL Bank's potential credit card market share in the medium term. So Morgan Stanley says it is a negative because in the medium term, the earnings could be impacted. Investec has actually cut the target price to 170 rupees. They expect the headline credit growth to also moderate by about 200 basis points in the current financial year because of the move. And Citi also says, this is a negative, and the management, they say, expects the credit card portfolio to grow at about 10 to 15% in the near term, which will be slightly lower than the industry average.
Okay, all right, big development there between Bajaj Finance and RBL Bank. Ritu, thank you very much for that. Well, with that, let's now put the spotlight on the CNBC-TV18 news break confirmation. This, of course, happened just after market hours on Friday. Aster DM will merge with Care Hospitals to create one of India's largest hospital chains. The new merged entity will be termed as Aster DM Quality Care. And it was our colleague Rachna who got you that story. So she's got it spot on, and she's joining us in the next couple of seconds to take some more questions with the management. We have Alisha Mopin, Deputy Managing Director at Aster, with us. Alisha, good morning. Thank you for joining in. So we went through all the details. I mean, for the benefit of our viewers, this entity is going to have a combined bed capacity of over 10,150 beds, I think, and a revenue of about 7,300 crores. You already have targets of adding more beds as you go along. Let's start with the basics. What are the synergies? Because you're also saying that this merger is going to be EPS accretive from year one itself. So what's the thought? And, what is the kind of competitive might you're looking to build in the industry through this merger?
Thank you. Thank you, Surabhi. Yes, we're really excited about the merger. Exactly as you said, this will make one of India's largest healthcare providers with more than 10,150 beds. Now, when you look at the combined synergies, scale is everything in India, and especially in healthcare, it helps a lot. So when we were looking at it, when it comes to cost synergies with buying the capex, buying materials, when it comes to insurance negotiation, when it comes to corporate costs, we see a lot of synergies. But even if you just combine forces, when we look at our margins right now, EBITDA margins around 17%, it actually moves up to 19% in a post-merge scenario. So, which is why, exactly like you said, it's EPS accretive from day one. This merger, it values the entire deal at more than $5 billion. So we believe that this is one of the largest healthcare transactions this year. And it's about really bringing together a merger of equals, right? Like, we know only healthcare as Aster DM Healthcare. And you bring in up marquee private equity as Blackstone, and you've got a lot of synergies. Blackstone actually invests a lot in life sciences. So we get the best of both worlds in terms of knowing what's happening, what are the advances in healthcare, and how do we kind of really have that first mover advantage when it comes to what are the changes in healthcare in the future. So quite excited about what combining these forces could bring about for Indian landscape.
All right. Hi, Alisha. Good morning. Good to see you, Win. We've had Dr. Azad, who joins us on the show in the past, but good to see you, Win. This is Nigel on this side. Just to quantify the number that you put out, the merged entity is expected to see a EBITDA bump up of around 10 to around 15%, which will be great news, which bakes in those synergies you're talking about. But by when is this expected?
Yeah, so we think with all the regulatory approvals, that will take us around 12 months to 14 months. And we'll start the integration process over the next 12 to 18 months. So we should be able to see the additional 10 to 15% EBITDA margin expansion, maybe in sort of 2 years. 24 months to 36 months is when you really start unlocking those synergistic opportunities, to be honest.
Alisha, hi. Congratulations. Prashant here. Our colleague Rachna is with us. She broke that story first on the 5th of August. Rachna, congratulations. Go ahead.
Sure. Thank you so much, Alisha, for joining us. I wanted to know, like you said, it's one of the biggest deals in the healthcare space this year. So what are the challenges that you foresee in integrating operations of something like Care, which was recently acquired by Blackstone itself? They haven't been in the space for more than a year. And now with this merger, what are the short-term financial pressures that you're seeing? Also, what are the challenges in integration?
Yeah, so Rashna, definitely we know that when you bring together two big platforms, there are going to be a fair amount of challenges in terms of integrating people practices, integrating IT to get the right information. So healthcare is very people-centric, and people practices will be different in different sort of companies, right? And like you said, Blackstone has just come in the last sort of 8 to 12 months, and they've got 3 brands within them. They've got the Care brand, they've got the Kim's brand, they've got the Evercare brand, and then there's Aster Us. We are largely organic. So trying to ensure that there is alignment of those culture, the soft part of it, I think that's really important. So that's going to be the main focus. And then, of course, to add to that, we definitely want to make sure to act as an integrated platform. You need to build in the IT integration. So that technology integration is going to also be critical. So we're very committed to make sure that we iron out, especially the people practices, because that's what's going to really help us unlock the benefits of being the scale and become an integrated platform where you really can deliver care at a different level from a patient perspective and from a clinical outcome perspective.
Sure. I also wanted to understand, how do you plan to address bed shortages, considering that's a very big issue in India? Also, Care is in Kerala, where Aster is also present. So how do you make this work in the same geographies, and what other geographies will you be targeting?
Yeah, so great question, Rachna. So we think that the geos are quite complementary. You're right. We, as Aster, we're there largely in South India, but Care also has a lot of presence in Central India. So this actually ends up opening us from 15 city micro-market leadership to more than 27 cities micro-market leadership. So you're right. In Kerala, there's a bit of overlap. In Hyderabad, there's a small overlap, but actually we end up having exposure now to Madhya Pradesh, Odisha, Chhattisgarh, Tamil Nadu, a lot of new markets, which will be great for us to kind of expand into Central India. So we find that quite exciting, because when it comes to growth opportunities, we will have 10,150 beds. We already have close to 4,000 beds in the pipeline. And we also have a lot of cash on the balance sheet from the GCC transaction that happened in Aster. And Care is hardly levered. So that actually helps us make sure that if there are good opportunities, we are very sort of keen and opportunistic in terms of acquiring more beds and scaling it up further. So I think that's really the benefit of Blackstone coming in, as well as the way our balance sheets are right now.
And that's pretty interesting. So you're already hungry for more, and it could be through the inorganic route as well. Got it. So just very quickly, some numbers, Alisha, because if you look at the CAGR growth rates, then there's a bit of a differential. I think Aster has been growing at 25% odd, Care at more conservative, I think 10 to 15%. So just give us some numbers. On a sustained steady state basis, what's the top line growth that you'll aim for? You've already given us the margin picture. And on the balance sheet, since you mentioned that balance sheet strength and you're looking at more inorganic acquisitions as well if they come along, what's the cash on the books right now? Will you have to raise any more equity capital? Just give us an update on the balance sheet as well, and the level of debt that you will maintain. I mean, you won't go cross above a certain threshold, say.
Yeah. Sorry, your first question was around?
Revenue CAGR, and then the debt and the cash.
Yeah. So revenue CAGR, you're right. Aster has been outperforming its peers, and we have been growing much faster than most of the peers in the industry. We expect at a combined level, we'll still be able to be close to 20% CAGR. I think what has happened also is since Blackstone has come in, there has been a lot of investments that they've been making in terms of infrastructure upgrade. So I think there's been a little bit of a delay in some of those investments paying off. But at a combined level, we expect that we should be able to do still a 18-20% revenue CAGR over the next couple of years. When it comes to sorry, your second question was on the
debt equity.
Debt, right? So on debt, I think our comfort level is probably to go to around 2x, is sort of a comfortable level for us. So right now we hardly have any, I mean, there's no debt actually on the Care balance sheet, and the Aster India business is also like sort of under 1. So we actually have quite a bit of, you can take, I think, probably up to 2,000 crores of additional debt easily without any challenges. And that's and then you can add the cash which is there, like I mentioned, there's 1,500 crores of cash on the balance sheet of Aster from the GCC transaction.
Sure. Alisha, lastly, I'd like to know, are there any plans to make an exit from the India business, considering now GCC is separated, and with so much private equity action coming in the space, we're seeing many examples of promoter families exiting?
Yeah, so not at all. Dr. Mupin will be continuing as the executive chair of the combined entity.
Got it.
We've had private equity coming in for a long time, but we expect them to be joining partners, and someone like Blackstone really sort of scale and build Aster further for us. But as a family, fully committed to being part of the Indian healthcare story for decades to come.
All right. We wish you all the best of luck, Alisha, from all of us here. And it's a big deal. And thank you very much for taking out the time and joining us here on CNBC TV18 this morning. Rashna, thank you. Well, we'll take a quick commercial break here. We're going to come back. Prakash Devan is going to be with us on the other side. We'll have some technical ideas as well with our experts. Stay tuned. Lots coming up.
Welcome back. Hope you're having a good morning. Well, we have listed out a lot of stocks that are going to be tracking for you. We have Prakash Devan who joins us to help us out with what he's tracking and how he can help us out with some fundamental analysis. Hi, Prakash. Good morning. Good to see you in. Let's talk about Aster DM. We just had the management. What's your view on that one? They've given some very, very high projections, but your view at 500 rupees. And also, I wanted a quick comment on Greaves Cotton. They're finally looking to unlock some value via the IPO route of the EV company. But it's looking challenging out there, the space itself. Your take.
Good morning, Nigel. Lovely to be on the show. So I think Aster DM is probably finally getting to do things that the market would have anticipated for quite some time in terms of a trigger to re-rate itself. Look at how it's performed in the last 4-5 years. If you take the pandemic-related business out, or the increase in business out, it's been fairly flattish. And that the demerger also was something which took some time, longer than anticipated. The impact of it has finally been digested. But honestly, the at 25,000 crores, it's a very good asset that trades at just about 5 times where the market probably accords an 80, 90 PE to a lot of the other businesses. So it has value. There's no doubt. What this does is it kind of helps it scale up, which was missing. It was always relegated as a regional player, and it probably has the opportunity to break out of that. And this acquisition that they made, I was just looking up on what Care Hospital has been specializing in or known for, and they've started using a lot of experimental AI in terms of procedures and remote procedures. So that all of that actually behoves well for the business to kind of grow. And what Alisha was mentioning in terms of the PE, help that they could get in terms of smartening up their operations, that could probably be a good trigger. So yes, quite positive. It's not overvalued at all in this market. Very difficult to find. They say, of course, there have been reasons for that low multiple, but this could help it re-rate as they start kind of performing. People will probably wait for a quarter. Serious money will come in once they understand the combined entity reporting some very good numbers.
All right, Prakash, stay with us. We're going to come back with more questions. Let's take a quick commercial break. Mitesh and Sudarshan will also join us with some technical trading ideas. So that's coming up.
Welcome back. You're tuned into Bazaar Morning Call. Well, as promised, we have our technical experts with us. Mitesh as well as Sudarshan join us on this Monday morning. Good morning, gentlemen, and thanks a lot for joining in. Mitesh, you go first. Everyone's talking about the GDP print that was much lower than what everyone was working with, but that's backdated, right? Now it's putting pressure on the RBI that you need to do something about, things. How would you approach a trade today? For the last I checked, I think GIFT 50 was suggesting 30-40 point bump up.
Right. Good morning, Nigel. So I think, yes, I mean, it will have some kind of an impact, but maybe the GIFT Nifty kind of adjusts that. So we'll go with the GIFT Nifty itself because anybody who's following technical will believe that price is the ultimate thing you need to follow in the market. So it's also backdated, but I think, it will possibly, make some people optimistic about a rate cut, if not immediately, but in the coming months in case we don't see improvement in the numbers. So that's maybe for something in the future. But coming back to the Nifty right now, I think, the recovery on Friday was very good and that makes, things slightly optimistic. Again, the first test and the most important test, which also, stood last week was 24,350 odd zone, so give and take 10 points. Broadly, we saw about on 4 days last week, the markets kind of tested those levels but failed to sustain above that. So I think this entire week we'll keep a close watch on 24,350. Fresh aggressive longs on the index will be taken beyond that. And then we'll look at 24,500, possibly 24,660 as well.
No, I mean, 24,350, I think important on the upside. Let's see if we get to it once again, at least intraday. Well, let's get some trading ideas as well. Gentlemen, morning. Mitesh, you go first. What do you have?
I have all buy calls today, Prashant. Good morning. Buy on GSFC, and the entire fertilizer pack was, very strong on Friday in the recovery. So maybe we'll see some good continuation over there. So GSFC can be bought with a stop at 219 for targets of 235. Bata was a call on Friday as well. Even now, I think can be bought, still showing momentum and reversal from very oversold levels. So keep a stop at 1395, look for targets of 1445. Biocon is a buy with a stop at 360 for targets of 380. And JK Cement is the final call. Keep a stop below 4200, look for targets of around 4450.
All right. Thanks for that. Sudarshan is ready now with us as well. Sudarshan, morning. First, your thoughts on how you'd want to approach the indices for a trade, and then we'll get to stocks.
Yeah, good morning. See, the idea is that the Nifty is now giving us signs of life, at least signs of life for the bulls. It's seasonally a good period to be on the long side of the market. The Nifty had a recent decline, so some of the fluff has gone away. It's built a small base, and the signs in that base building chart are that it's looking for higher levels, at least 25,000 plus. So the trade, for positional traders, there is a single trade, be long in the Nifty in whatever way you like, options, futures, ETF, whatever. And for intraday traders today, we can see knee-jerk reactions because of news, but every dip remains a buying opportunity. For today, if you see a sharp dip, go long in the Nifty. And also separately keep some long positions anyway.
Okay, all right, got it, gentlemen. Just to talk about some of the specific ideas as well. Sudarshan, good morning. So which stocks will you go with today?
Sure, it's an all-buy list. The market is now giving us signs of cheer. ACC is a buy with a stop under 2180. PVR Inox is a buy with a stop under 1525. Torrent Pharma, consider buying with a stop under 3200. And finally, UBL, United Breweries, is a buy with a stop under 1900. These are mid caps because we are covering large caps in the Nifty anyway.
Okay, all right, got it, gentlemen. Thank you very much. We'll come back to you a little closer to market opening and get some more trades going. Right now, a quick break. We come back on the other side. We'll have the pre-opening rates. And don't forget, the bond market opening is going to be really important today with that GDP print. Also, we stick to that story on financials and what does this really mean for policy expectations and for listed financial stocks. Samir Bise of JM Financial Institutions joins in with some ideas.
Okay, welcome back. There's about 15 minutes to go for the market open and 15 I think the pre-open is coming up on your screen in just a bit from now. I think pre-open is kicked off. We'll have the first rates coming up on your screen. The rupee as well, I think, should be important to take a quick note of. So this is of course, I mean, exaggerated and all over the place, but dollar rupee should also come up in just a bit from now. Prakash Diwan is with us. Prakash, good morning. Just a quick word on this RBL Bajaj Finance news flow. If you that termination which has happened, the partnership ending, and we've got a sort of banking analyst also joining us in a bit. What's your sense? I mean, it looks like it's meaningful for RBL Bank.
Oh, good morning, Prashant. Oh, absolutely. I think it's definitely something which suddenly stops the gravy train. There's no distribution might that RBL can bank on in terms of growing its book on the credit card side. But to be honest, there is a lot that RBL needs to do in terms of getting its act together, and especially at a time where all other smaller banks, comparably of the same size, have really done things very well in terms of consolidating their books, their reach, their NPAs. There's so much that's happened on Federal Bank or even a DCB, which otherwise we really don't talk much about. So RBL, probably this is a wake-up call of sorts in terms of that. And I think the stock's already seen that reaction, lose almost like $100 in the last few months. For Bajaj Finance, of course, the origination fee, does kind of stop coming, but it also kind of prevents them from, a regulatory risk overhang perspective. And they would rather focus on something which is straightforward. So I think it's good for Bajaj Finance, but incrementally it's more negative for us.
Okay. By the way, I'm looking at the benchmark 10-year bond yield. Let's see if we can get the 2034 yield up on the screen. It closed off Friday at around 6.75, and this yield has been very range-bound. Last 2 months, equity market has been correcting, going all over the place, and the rupee has been weakening. But the yield has been quite steady between 6.7 at the lower side to about 6.8, 85 on the higher side. There's a bit of an inch up in the market right now. One of the rates I saw was also around 6.79. Again, going back to the 6.8 handle, because obviously, I mean, that print is pretty weak. But the expectation is going to be that the RBI will start cutting more. So let's see if we start seeing some sort of a bond rally. The rupee continues its weak trajectory. There's no change there. And on the equity market, now the market seems to be stabilizing. The cut is about 100 points lower on the Nifty. But let's see. Let's give it some more time as we go forward. Prakash, very quickly, Adani Group. So once again, I mean, those who could trade in and out of the situation fast enough, I mean, they would be happy because they've made money, because there's a fair amount of rebound from the lows. But what thoughts? From a portfolio perspective, are you comfortable going back and holding any Adani stocks now?
So, importantly, what this shakeout of sorts tells you is in terms of a crisis, if there were to be any, in terms of a news flow or triggered by any kind of a news flow, some of the businesses in the group are proving to be fairly resilient. The stocks are proving to be fairly resilient, given that valuations are not straight. So one is, of course, ports. Their investor day at the Vindhyam port has actually built so much of confidence around that. If you look at the notes, you'll see what kind of growth they're talking about. But I'll tell you what I would focus on out of the Adani portfolio. It's the Ambuja ACC play. It's so simple. Ultratech just announced a debottlenecking-led growth of 0.6 MT. Now, imagine if Adani were to start kind of doing that as a group, and they've been talking about it, but probably, things have not been very stable. If those efficiencies come in, these stocks that you're buying today, the cement stocks, are probably available at a very good opportunistic kind of level. So there could be growth without incremental costs attached to it. So I would look at that for sure. But of course, Adani Enterprises continues to be a very promising bet, but value unlocking and all of that is something which we really don't know timelines about. But I would look at the cement place.
Okay. All right, Prakash, take that point. We will leave it on that note. Shorter chat today, lots to cover. Thank you for joining in, and we'll connect again soon. While we're on the subject of the Adani Group stocks, now this is his first public comment after the recent allegations, as well as the indictment of several top executives of the group, including Mr. Gautam Adani himself. So Adani Group chairman Gautam Adani was actually speaking at a public event, and he says that his conglomerate was committed to compliance.
Fact is that despite a lot of the wasted reporting, no one from the Adani side has been charged with any violation of the FCPA or any conspiracy to obstruct justice. Yet, in today's world, negativity spreads faster than facts. And as we work through the legal process, I want to reconfirm our absolute commitment to world-class regulatory compliance.
Okay, so he's saying that we're committed to world-class regulatory compliance. Let's see which way things go with the US SEC as well as the case in the courts over there. But back to the big story, and that is how the financial markets are reacting to this major GDP howler. Yes, the numbers are bad, but it's also getting the market really excited that the RBI will quickly start offering rate cuts, which is also up for debate. Because remember, the last CPI print was well above RBI's comfort zone. The CPI printed above 6%. So will the RBI bite in December itself, on Friday itself? That's the big talking point. And what does it mean for financial stocks, the listed stocks? That's what we're focusing on. Samir Bhise, banking research analyst at JM Financial Institution, is joining in. Samir, your first thoughts on, what you would expect in terms of, treasury gains, if any, if that could be something important to look at. And this, I'm only talking about the near term and also obviously the NIM trajectory. Whether you think the RBI will start cutting faster than expected post this GDP print, and whether that will, alter your view or influence your view in any way.
Hi, good morning. So I think in our base case, clearly a December rate cut is a relatively lower probability event. However, what the GDP print does is probably moves it closer than what one would have expected. My primary view, or how we are thinking, is probably liquidity management, which has been tight for a prolonged period of time. You could see some steps coming on easing liquidity. I think that could be the first steps from the regulatory perspective to ease in the environment and probably give a push to growth. However, RBI has multiple times said that probably the inflation battle is not won yet, and hence they would still continue to focus on that, which is what the primary responsibility of the monetary policy is. So in my assessment, I think a near-term rate cut looks more difficult. Probably we could see some bit of easing on liquidity, is how we are thinking about it.
Okay, so I guess that, the weekend developments don't really change your stance per se on stocks and sectors. So just moving on to the other major news development, which is this whole co-branded credit cards business and RBL Bank and Bajaj Finance. Do you have coverage on either of the stocks or both of the stocks? Any thoughts?
So we don't cover RBL Bank, so would want to kind of refrain comments. Just that it has been on expected lines prima facie, because reliance of RBL Bank on Bajaj sourcing had been reducing over a period of time.
Samir, hi, morning, Prashant here. Just to go back to that first point on growth and etc. And markets, of course, always latch on to help either from the fiscal or the monetary side, and the monetary is, of course, also around the corner with the RBI policy. It's not so much about what will happen in this policy on Friday, but one of the reasons why personal consumption has also taken a bit of a hit is because the regulator has tightened the screws across the board, right? NBFCs, MFIs, banks, etc. In terms of, asking companies, and rightly so, to toe the line in letter and spirit. And this year we've seen so many actions in that sense. At a broad, slightly higher level, do you think, Samir, we should expect maybe some loosening there because, liquidity is hurting? I mean, banking credit in that sense has been tight.
Yeah, so I think fair expectation to have. I think the regulator remains concerned on the leverage building up on the entire consumer credit side, which is what had caused them to start tightening last year. I think a large part of that has actually resulted in this kind of a slowdown in terms of consumption, and fairly so from a regulator's perspective. they are willing to get the system right, even if that means foregoing some near-term growth. And the way unsecured consumer credit had been growing last few years, I think it was only warranted. I think at some point in time in first half of next year is when we would see the large part of this impact has flowed through the sector in terms of weeding out the painful points. From a regulatory stance, I still think rather than just signaling a rate cut, I think there are other ways where they could see easing of some of the requirements. Maybe it could be CRRs, or there could also be some ways of easing LCRs, which is what the primary guidelines had suggested, that they could be further tightened. Maybe you could see some bit of tweaking around that, given the way growth is panning out.
Samir, for investors who are watching, from a financials perspective and stocks under your coverage, are there any straightforward, absolute return ideas here, or it's all a little?
So I think we have preferred.
Yeah.
We have preferred larger banks over the smaller ones. I think that has been the stance over the last 1 year, have been highlighting. So I think that still continues. However, would like to highlight that if a rate cut plays out, in the extreme short term, it probably is a minor negative for the sector, given that large part of the asset side is linked to repo rate, and that would reprice lower immediately, while deposit repricing would follow later. In such a context, I think the toss-up is between who is impacted less. We still think that larger banks are better placed to kind of navigate. They also do not have meaningfully high exposure to the unsecured bit. So asset quality risks are also lower. Our top picks are ICICI, Axis and SBI. I think that continues to be the case.
ICICI, Axis and SBI. Got it, Samir. Thank you very much for joining in. By the way, in the market, it's just like Wall Street, right? When not so good news is actually very good news. And that's what it seems to be. Both on the bond yield and on the equity market, there is green. On bond prices, the yield is actually lower is what I meant. Because the market seems to be now thinking that it's bound to happen. Maybe not on Friday, but the RBI will move. Maybe easier liquidity stance, maybe a rate cut, maybe a CRR cut. But I think the market's smelling something, or at least wanting or wishing something, which is why you're seeing the the equity market also. Forget that gap down in the pre-open. Now it's actually a 10-point up move that we're getting. And the Bank Nifty is very steady, 30 points higher on the Bank Nifty as well. Okay, let's quickly go back to our technical experts for some more ideas. Sudarshan and Mitesh back with us. Sudarshan, what's the trade?
Well, consider buying ACC with a stop under 2180.
And Mitesh?
Buy on GSFC for targets of 235.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's revise a couple of stocks that are going to be in focus. RBL Bank is down, one of the biggest losers in pre-open. Ritu joins us to fill us in on all of those details. Ritu?
Well, yes, Nigel, a negative because RBL Bank and Bajaj Finance have decided to stop the issuance of new co-branded credit cards. The continuing, the existing portfolio will be serviced, which is about 3.4 million cards, but no fresh co-branded credit cards will be issued under the partnership. And this, as our experts were just saying, is along expected lines. Their dependence on Bajaj Finance has been coming down. For instance, the number of cards issued along with this partnership has come down from 1.26 lakhs last year to about 37,000 only as of September this year. The credit card total origination through Bajaj Finance has also come down from a peak of 65-70% to just 36%, while RBL Bank is focusing on own origination and also launching partnerships with others like M&M Finance, IOCL, IRCTC, and TVS. Now, brokerages largely believe that this can impact RBL's potential credit card market share in the medium term. The ROA may improve, but this is net negative for the medium term earnings growth is what Morgan Stanley says. Investec has also cut the target price to about 170. They believe the headline credit growth could also moderate by about 200 basis points. Citi also says that the earnings impact will be determined by how quickly RBL Bank is able to transition this lost partnership business to direct sourcing and to its new partnerships scaling up.
All right, Ritu, thank you very much for that. Thank you. So that is RBL. It's, I think, done about, 4-5% or so. Just a couple of seconds to go for the market open. We'll look at indices as always, and then we'll get down to individual stocks, etc. You got it's a slightly positive start, so flattish start, 24,140, neither here nor there. Nifty Bank is blinking, in an undecided way, nothing. 52,000 flat in the Nifty Bank. Sensex is down about 0.1%, and the mid-cap index is also holding on to some green, and now it's in the red, but nothing on it, nothing to show for it. Maybe a little bit more now. Nifty down about 80. So let's see, 24,050 is where the Nifty is coming up at. You got more red than green as far as the Nifty heat map goes, and we are at I think 30 odd names lower. Some unchanged, still opening up, and the rest which are higher. So it's got shades of more red than green at this point in time. Nifty Bank is down about 0.4%. That's a 200-point cut now. So it's a little more, lower to begin the day with. So that acknowledgement maybe of that weaker GDP numbers coming through, it would be kind of weird, right? If the market opens up 100 points with a 5-handle GDP number. So you got that acknowledgement coming through. But as we've been saying, it's not as if the market did not know that growth is slowing. Corporate earnings foretold the slowing number, although not to take away from the shock value of that 5-handle number, 24,050 on the Nifty.
The shock value and also, Prashant, inflation, right? The market also knows that when inflation is running above 6%, can the RBI really suddenly go out and do a bazooka? Maybe not. And that reality, this twin problem of slowing growth and very sticky inflation, this is really weighing on the market's mind. Let's see. 70 points down on the Nifty. So what's weak? Almost everything, barring auto, by the way. Britannia, lower by about 1.5%. Some of the life insurance stocks are still falling. HDFC Life, for instance, is down 1%. Lever is lower. ONGC, L&T, Infosys, TCS, Titan. You can see it's cutting across sectoral lines. It's not one sector that's taking the market down. The Bank Nifty is down in sync, in step with the Nifty, a cut of about 0.3% there as well. Reliance, ICICI Bank, SBI, Bajaj Finserv. Actually, let's see what's happening to Bajaj Finance as well. Bajaj Finance is down about 0.5%. So everything down, barring, like I said, autos. Let's pull some of those names higher. Bajaj Auto, Tata Motors. Maruti Flash, a bit of red, but I think it's already slipping. So yeah, let's see if this lasts. Shriram Finance is doing very well. 1.5% up on Shriram Finance. Okay, so is the market thinking that maybe there'll be more tie-ups coming Shriram Finance's way? I'm not sure. Maybe that's a simplistic argument. But anyway, for what it's worth, it's the best performing stock on the Nifty. There's Sun Pharma that's continuing its good form from last week as well. So that's about it. 82 points down. It's a weak start.
Well, some further gains coming in for Aster DM. The street likes what the management had to say, that EBITDA number is going to move up by 10 to around 15% in the next 24 months. So that's why it's building on to gains, up 4%. From the Adani Group stocks, Adani Green, that's firing away, up close to around 7% on large volumes. So that's one of the top volume movers in today's trading session. From the frontline names, the Nifty is down close to around 80 points, but you have Adani Ports that opened up mildly in the green. There was that visit that Nuvama had done as well to their site, and that stock in fact had opened up with some green. Now it's up only around 0.5%. EV plays are in focus. Greaves Cotton, finally that value unlocking is likely to take place. That's what they've disclosed to the exchanges. Market share has been a little bit jittery. I don't think they have a PLI as well in there, and there's a mad scramble with regard to the EV market share. But for the time being, the stock is still holding in the green, up close to around 3%. I'll be interested to see whether or not the street holds on to those gains, because the environment clearly is challenging, as we have seen from Ola Electric. Last week, it saw a big run, but market share is slipping for them as well. So that's why the stock has cooled off. One of the top volume losers on the downside. Ola Electric comes up for you. The other couple of stocks, Home First Finance, at large trade, I think, has just taken place. And the low of the day is something that I'll be monitoring. I think it is at around 985 approximately. So keep an eye out on that one. I think that large trade has taken place. Aeroflex, that's one of the stocks that is up in the green, up close to around 5% as we speak. So keep an eye out on that one. And in terms of order wins, KEC and Kochi Shipyard, both of them higher on order wins is what we have seen. While KPI got some forward movement with regard to one of those orders. So I think we should get that one as well up for you on the screen. Prashant.
All right, almost a 100-point cut on the Nifty, 24,033. More stocks coming up in a bit. We've got Karthik Kumar now joining us, fund manager at Axis Mutual Fund. Karthik, good to have you with us here as always. Thank you for your time. You got this 5-handle GDP number now in the mix. Does it change? How does it play for investors, for people managing money in terms of how you're approaching things? Complicates the situation, or you think it's kind of fully sort of factored in? And in any case, expectation was that Q3 and Q4 both on the monetary side and the fiscal side, things will ease up a little bit. Go on.
Thanks for having me. As you said, it probably complicates a bit. But having said that, we had expected softer numbers given the slowdown in high frequency indicators and also the fact that the earnings season wasn't as expected. So a lot of it was kind of expected, but the extent of the disappointment probably wasn't. But having said that, if you look at the markets from an earnings perspective, we've gone from an expected earnings for FY25 at 14%, and that has now come down to anywhere between 9 to 11%, depending on the universe you're looking at and the house you're looking at. So I think the earnings cut has already taken a large part into account. As you said, a significant portion of the slowdown happened because of slower government spending and slower credit offtake, which both one could argue that the government has levers going into the second half of the year. So that remains to be something that we need to watch out for.
Karthik, hi. So just give us the overall portfolio construct. It's a complex market that we're navigating, right? I mean, FIs are still selling. The correction, I don't think, is entirely over. Incremental local data has started slowing down. So just tell us the market construct right now. What are you long on? What are you avoiding? Just an overall view.
So as you rightly pointed out, FI is still selling, but the pace of selling has gone down significantly between October and November. And having said that, while the markets have corrected, but if you kind of scratch the surface, what you notice is that small caps and mid caps have kind of held off much better or much well in this correction. Plus, if you look at it from a sectoral basis, so something like a real estate, PSU banks, these sectors that typically you don't you think would underperform in these kind of environments have continued to do well, whereas your traditional defensive kind of sectors or sectors that we traditionally associated to do well with market corrections have kind of lagged during this period. So the market correction doesn't, if you look at the market surface breadth, it doesn't suggest that the market is panicking by any means. From a style perspective, again, you see over the last month, it's actually the slightly higher volatility stocks that have done better than lower volatility stocks. Higher beta stocks have done well last month, and even from a style perspective, momentum has kind of done reasonably well over the month, despite volatile November as well. So, and it's done well through the year as well. So those are the things that kind of suggest that while we are seeing market correction, this is more par for the course, and at least it's not panicking based on the market breadth. Areas where I am bullish on through our quant fund essentially is we are overweight. It is more stock specific rather than sectors in most cases, but we are overweight telecom, discretionary stocks. Again, when I talk about consumer discretionary, it is kind of diversified across subsectors and more stock specific. And then pharma, I would argue, is one area that is more sector specific, where there are stocks across sectors that look well. On the underweight side, continue to be underweight private banks. I continue to be underweight commodities in general. Those are the main areas of overweight and underweight.
All right. Hi, Karthik. Good morning and good to see you. Well, at that call on private banks, I recall you've been underweight for some time. And I think at least for now, it's worked out. You know, and these FI selling, they'll be selling where they hold the largest amount of stock. And that's actually some of these banking names. But let's delve a little bit into sectors you're overweight on. If you said it's going to be stock specific. But if you could help us out, telecom case in point, are you all playing the core telecom company? If you could give us some idea on that. And dwell a little bit more into consumer discretionary. What do you like out there?
So as you kind of hinted at it, telecom, we are playing through the core telecom companies. In discretionary, it is a good mix of two-wheelers, gold, some gold link plays, gold link companies, and lastly, fast fashion companies as well. That's where we have exposure to on the telecom side. As you touched on within financials, you can bucket stocks within the financial category into different subcategories. And I think capital market plays still look kind of quite interesting versus some of the private banks. Having said that, I'm selectively overweight private bank, but largely private bank as a group still continue to remain underweight. No, largely because there is opportunities elsewhere in that space.
Okay. By the way, just pointing out, The market is down 100 points. So there's no early recovery of sorts. It's still a bit of a slippery slope. Mid-cap index holding in positive territory.
Absolutely. Lots of stuff moving around though, and market breadth is catching up, and that's a good thing. It was steep, it was sharply lower, so 800 stocks were higher and about 1,200, 1,300 stocks were up. And now you got about 1,000 plus stocks in the green and about 1,250 in the red. The divergence is not that sort of large in that sense. As we look at things. Sagility is one name which started lower. It is starting to already sort of pick up once again. Some of this stuff, of course, has done very well recently. AG's Logistics, for example, that is seeing a sharp 7% odd cut coming through. But again, it's had a decent run from the lows recently. And if you look at the Adani Group stocks, it's a kind of mixed picture. Ports is higher. But you look at Adani Energy Solutions, names like Adani Total, they are down, but just some profit booking. But because from the lows, they've also come up quite nicely at this point in time. 115 points lower is what you have on the Nifty. Surbhi.
I just was wondering if we picked out Dixon or not. Dixon is surging on good volumes as well because of the fact that they're making the Pixel phone now. It's another marquee sort of logo getting added on in that respect. Anyway, we spoke with the company last week. Their targets are very, very smart in terms of growth and margins. All the businesses are firing across the cylinders, so to speak. Okay, Karthik, so just to go back, you've made the point on the underweight call on financials and consumer discretionary. You said that you like some of the gold financiers. Anything else? Because on consumer discretionary as well, there's been a lot of debate about whether there is this urban slowdown, though I know the Black Friday sales apparently have been a huge raging success, but that's thanks to the discounts.
So slight correction there. I like the gold plays within the consumer space. So gold, more like gold retailers, not necessarily financiers. That's on the consumer side. And as I said, very selective across consumer space in general, because while there are positive data points like you mentioned there, but in general, we are seeing the growth being revised downwards, and if anything, earnings downgrades being more focused on certain areas, especially in consumer, both discretionary and the FMCG space. So we are a bit cautious out there.
All right. We'll leave it on that note for this morning then. Karthik, thanks very much. Good to have your perspective in. Guys, by the way, I don't know if you all bought anything for Black Friday or not. Apparently, it's become very, very big this time around. Prashant? No, nothing? Okay. Anyway, let's go back. Speaking of consumption and growth in the economy, it's good to go back to the biggest story of the morning, which is this big GDP shocker that we got in the second quarter. 7-quarter low in terms of GDP growth. So what's the street making of it? Hormuz is here with the street view. Hormuz?
The consensus at the street is that every single brokerage has cut its FY25 estimates for the India's GDP growth going forward. And we'll start off with a few of them. And JP Morgan is the first one. And now there is a clamor that is growing in for a rate cut as well. But JP Morgan believes that they may see some liquidity measures coming in from the Reserve Bank of India. But the first rate cut that they expect is only in the month of February next year, although that the odds of the rate cuts have risen going forward. Now, Citi also believes that they have revised their FY25 GDP growth from 6.4% from 7% earlier. Although they say that this elevated inflation, it makes a December rate cut unlikely, but they may see some liquidity measures like a CRR cut coming in from the RBI next week. And also you could see some renowned urgency coming in when it comes to public capex measures going forward. Now, Goldman Sachs has also lowered its CY24 and FY25 GDP growth forecast respectively to 6.4% and 6% going forward. And they also said that they are maintaining their CY25 and FY26 GDP forecast at 6.3% each. Now, Jefferies also believes that this slowdown in government spending and bank credit growth, both of them are phenomena that could see a reversal in the second half of FY25. And as a result, they are the possibility of a CRR cut from the RBI in the next meeting, which is next week, which is later this week, goes higher as well. And Morgan Stanley also expects the rates to remain unchanged this week, but the RBI may announce some liquidity measures, saying that an OMO or an open market operation might be announced going forward. So the rate cut, there is still a divergence when it comes to rate cut expectations, but some liquidity measures can definitely be announced by the RBI this week.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's focus on the first management that we're getting post-market open. That's NLC India. The stock has been an underperformer this year. Single-digit returns is what we've seen. The company has a big capex that they plan more than 1 lakh crores. And also, we want to get an idea about how business momentum is shaping up. To help us out with that, we're joined by Mr. Prasanna Kumar Modupalli, the Chairman and Managing Director at NLC India. Hi, sir. Good morning, and thanks a lot for joining in. Good to see you, and as always. Well, let's talk about the renewable energy part of the business. You know, that's something that we quizzed you the last time around as well. And we will ask you, when exactly should we be seeing that IPO? What's the updated on the renewable energy part of the business? Could you give us some guidance about how that's scaling up? An IPO when last quarter of this fiscal or first quarter of next fiscal?
As you know, as on date, we are operating 1.4 gigawatt of renewable capacity, around 50 megawatt wind, and balance is solar, particularly in the state of Tamil Nadu. We are targeting to take this 1.4 gigawatt to 10 gigawatt by 2030, almost a 7-fold increase in the renewable capacity. So in this direction, all the activities are already in progress. We are going with the 300 megawatt project in our Barsingsar project in Rajasthan, and 600 megawatt in Khavda solar park, and 800 megawatt also in Rajasthan. And we entered a JV agreement with Rajasthan government for 2 gigawatt renewable capacity addition. So for reaching to 10 gigawatt capacity, we are already having plans. As you rightly said, we are targeting to monetize our existing renewable assets, 1.4 gigawatt. For that, we formed one renewable 100% owned subsidiary, that is NLC India Renewable Energy Limited. Now we are in the process of transferring the existing assets to NIRL, that is NLC India Renewable Energy Limited. And recently, we achieved a major milestone in that process. We received capital gain exemption from Ministry of Finance, Government of India, which is a major milestone for transfer of the assets. So once the assets are transferred, I think by the third quarter of the next financial year, the actual process of the IPO will come.
All right. So, Mr. Modupalli, you're telling us that now that IPO, renewable energy IPO, should be something that we should look forward to in the second half of next fiscal year. You know, earlier this week was hoping to hear about it in the first half. But now you're saying give and take everything, you're expanding capacity, and realistically, we should look forward to it only towards the end of FY26. Is that correct?
Exactly.
Okay.
All right, Mr. Modupalli, hi, good morning. Good to have you on the show. I just want to understand what's happening with respect to lignite mining at NLC itself. I think there were some land acquisition issues. There was some arbitration going on. But is that all of it resolved? And by when can we expect the contribution to start happening?
Madam, the last year, H1, there was a substantial loss of generation on account of lignite non-availability. As you rightly said, there were some issues of land, and there was some diversion of river was pending. So we, in the first half of the last financial year, we completed the diversion of the river, the Parmanar River, as well as a substantial portion of lands were taken into possession. So from January 2024, our lignite production is to peak capacity, and we are not losing any generation on account of coal. In fact, in the last financial year, we achieved all-time highest ever coal plus lignite production. So as on date, all our mines are operating at full capacity, and the major land acquisition issues are sorted out. We are having sufficient land to carry out the mining activities going forward.
Fair enough. So can you just give us an update? How much do you think the lignite business can contribute to the overall revenue for this year? What are the projections? And that will bring us to the overall expectations as well. I mean, if you could just then tell us about the regulated equity, the outlook for this year and the next year.
Well, our lignite production last year was around 23 million metric ton. This year we are targeting more than 25 million metric ton. Coming to the contribution, most of our lignite production we use for power generation because it is a pithead stations are available. So our contribution, our whatever revenue comes, that comes from the thermal power generation, not exactly from the lignite production.
So regulated equity, sir, FY 25 and 26, what are the targets?
FY 25-26, I'm talking about 25 million metric ton of lignite.
Got it. Now, sir, what we're referring to is regulated equity. I think as of now it is approximately 8,000 crores. Is that correct? And I think you have a plan to take it to around 23,000 crores by 2030. So can you tell us if that is on track? I think in the next 1 year or so, from around 8,000, it's expected to go up to around 11,000. Just want to reconfirm about this regulated equity and the way it's going to move up.
Exactly. What you're telling is correct. It is our regulated is around 7,000 odd. And as our Ghatampur thermal power station is COD of unit number 1 is about to happen, and other units also will be completed earliest, then we will be reaching to regulated equity 7,000 crores. And after we add the capacity at Talabira and Neyveli new expansion of 2 into 500 megawatt, finally by 2030, the regulated equity will become 23,000 crores. And by 2030, we are targeting for 10 gigawatt of thermal capacity and 10 gigawatt of renewable capacity. So the regulated equity will be 23,000 crores, and almost that much will be in non-regulated equity also.
All right, we leave it there, sir. Thank you very much for joining us and running us through all of that detail. Good luck to you and your team as you continue to execute. Look at the market, by the way. The Nifty is recovered and sharply so from the lows. We are down just about 40 points. That we basically, come up quite nicely. And the advanced decline ratio, it's now flipped. So 1,300 stocks are higher, and you got about just under 1,100 stocks which are lower. There you go. That's what's happened in the last couple of minutes that we've been in conversation with the NLC management. Just to look at stocks here, I think CAMS is a new addition in the mix in terms of what's doing well. CAMS is up about 4%, 5,120 or so on CAMS. Cochin Shipbuilders, I think 5% higher, 1,656 or so. Torrent Power was not there in the mix in the morning when we started. It's about 5% in the green. There's Hikal, which is up 5%. Viatech Vabag is a new addition, at least in terms of the volume-led gainers list. It's up about 4%, Viatech Vabag. Himmat Singh Ka Seed, the textile apparel maker, 4%, 187 on the stock. More names. NRB Bearings is up about 6%, and it's got decent-sized volumes for this point in the day, 300 plus on that one. EPAC Durables is up 5%. The volumes then are still picking up on what is higher at this point. But there is a solid recovery which seems to have set in, although this is still the first, 30-odd minutes of trade that we are tracking. On the downside, Afcons is down about 2.5%. It's a recent listing. BKG, I think we highlighted. GE Shipping, I saw in the morning as well, down about 2.5%. So it was down from the morning. And of course, Home First, Ola, RBL, etc. are stocks which are down. Those are three biggest volume-led declines that we have, between 4 and 5% at this point in time. Surabhi.
Okay, I think that's the market recovering. Let's see if the bulls can prevail. We'll take a quick break on that note. We'll come back on the other side and we get chatting with yet another company. The management of Sheela Foam is going to be joining in. We'll not only get an update on the Q2 performance, but more importantly on the outlook ahead. Is the consumer really slowing down, or is it not that bad? We'll ask Rahul Gautam of Sheela Foam. Welcome back. The next management on our radar is the management at Sheela Foam. Now, the stock has been under a little bit of pressure of late. It has corrected about 35% from the 52-week high, but then the market has been correcting overall. So let's keep that in mind as well. What is the outlook for the second half? How is demand shaping up? And of course, how is the integration coming along with Kurlon. Lots of questions there with the management. So we've got Rahul Gautam, CMD of the company, joining in. Mr. Gautam, great to have you on. Thanks for being with us. So if I look at the the performance revenue second quarter, I'm just reiterating numbers for the benefit of our viewers. Your revenue was up 33%. The margin was lower because there were a couple of one-off items. But you tell us, I mean, before we talk about specific Kurlon integration, in general, how is demand on ground? Considering we are hearing a lot of this chatter about urban consumption slowdown. What are you seeing?
Thank you. Thank you very much for inviting me. So I think that I don't quite agree with you in the sense that from October onwards, when the season has, or the high season has begun, demand has been consistent and it's on the rise. Of course, we are governed not only by this season, but we are also governed by the wedding period. And this time is an extended wedding period which goes on up to the third week of December. So that may be a silver lining, but otherwise demand is consistent and high.
Okay, that's very good to hear, sir, because we do try and get this dipstick survey going with all consumer-related companies who join in. So you're saying you're not seeing slowdown, and plus this is the wedding season, so things should look good. So give us a sense, I mean, on a full-year basis, and now that sort of Kurlon is in your fold as well, on a full-year basis, what's the growth you're expecting this year? In a steady-state basis, the whole combined might of the big brands, what is steady-state revenue growth, say, for next year as well?
So I would say in the second half of the year, we should register anything between 13 to 15% growth. And we have to remember that Kurlon was added to the group only October last year. It was actually middle of October last year. So really the comparison and the impact of the integration and all that has been happening only in the second half. So we expect that by 31st March 2024, we should be 2025. We should really be ending with 14-15% increase in the revenue.
So that's total FY25 total revenue is up about 14-15%. Mr. Gautam, is that what you say?
I know. I would say that would be close to about 10%. But the H2 revenue would be up by 14-15%.
And then since we are all the way to about March of 25, would you want to hazard an estimate for the year after that, 26, when all of this would be completely integrated? I mean, what would the ambition be an overall company basis for 26?
So I think two impacts would be there. One would be our integration getting completed, and the second would, of course, be the environment part. As far as the environment part is concerned, I would not hazard a guess on that. Though it looks robust, there are no reasons why it should fall down or dip. But I think the real impact would be the integration part, which I would say is about 75 to 80% complete. There are a few things in the front end which needs to be sorted out, and we are on track for doing it. And as I said, it's been about a year that the acquisition took place, and as we all know, the integration is always a bigger thing than the acquisition part.
So for full year 26, would you want to go with a number? I mean, at least ambition-wise.
Ambition-wise, 15%.
15% growth. All right. Hi, Mr. Gautam. Good morning and good to see you after a while. This is Nigel on this side. I wanted three basic numbers with regard to Kurlon. You're sounding quite optimistic that the synergy benefits are playing out according to the plan. I recall when you joined us, you were talking about margins of around 13% on this particular entity. Revenue scaling to around 1,000 crores. And I think the combined market share would be around 29%. Could you tell us if that is on course?
So Nigel, on the market share, I would say that it's always very difficult. It's how you define the market. So if you define the organized and the unorganized together, it is not 30%, but far lower, because the unorganized sector is reasonably large. However, let's look at the organized one, and you're quite right that they would be 30%. On Kurlon, I think your statement about 1,000 crores and margins of 12-13% is absolutely spot on. That's what we should have.
So by when do we get to that number, that 1,000 crore revenue run rate?
The 1,000 crore run rate we would get into Q4 for sure, and even the year should end up close to that because we've been ramping up reasonably well. But the run rate would be there in Q4.
And okay, from Q4 onwards, you'll already be on course with regard to this 1,000 crore run rate. Ms. Gautam, when we get you in, we also get an insight into the raw material costs. So could you help us out with polypropylene as well as with TDI prices? What are they currently? How do they compare with what we have seen on average in the first half of the year? And how do you see both these two trending going ahead?
So both TDI is hovering between about 150 and 160 rupees, and polyol about close to 105, 110, just oscillating in that range. Both have been rather low and steady compared to the last quarter. And going forward, I would say that this is the picture that should remain, because any indication that I get from the bigger markets like the European Union or the US, the rates are only going down. But I think we are at a low level. Therefore, I don't expect it to go down too much, but to be steady and holding at this price or in this range.
Okay. Just a word going back to the integration with Kurlon and the synergies. I mean, combined now, what is the market share? You'd be at. I think the estimates are probably around. Correct me if I'm wrong. In the late 20s, right? And is there scope for market share expansion? And also, sir, a word on pricing, because you're saying the actual demand on ground is not bad at all. It's a big wedding season that we're in the midst of. So give us a sense on market share and whether pricing, whether the growth is going to be pricing led or only purely volume.
No, it's not going to be pricing led. It's not going to be. Okay. Of course, there will be some small little changes of 2, 3, 4% but that's not going to impact the top line so much. And the market share, we are, let's say we are 30% of the organized market, and we expect that share to go up as we move forward.
All right, very quickly, before we let you go, the two talking points are, is the Indian economy slowing down, and what is Trump's impact going to have on the United States? I recall when we chatted once, you said that the US could be closer on 100 crores of a revenue run rate. Is that on course, and by when do we see that?
Sorry, I didn't follow that.
The US revenue run rate, I think you were hinting that it could be 100 crore potential. Could you tell us?
Yeah.
Yes.
So I think that potential absolutely exists. It completely depends on the duties that have been levied, and US has been extremely erratic on levying these anti-dumping duties from various sources. India is aptly placed for supplying, but at the moment the anti-dumping duties of the order of some 35-40%. That's just too much for export to bear. We expect that to change as Trump comes in. He would be, but he's still a very loose cannon. I wouldn't hazard a guess, but with whatever relationships that exist between the country and his little bit of a bent towards India, we should expect this anti-dumping duties to kind of come down. Like today morning's newspaper, I just read that that he intends to put 100% tax on imports from China. Now, let him come in. But our duties should only reduce, which means it should improve our chance. Whether it makes it to the, just over the line to be in a position to export, we'll just wait and see that.
We'll have to wait and watch. As you said it, tongue in cheek, loose cannons. We don't know what to expect next, but you're saying the potential of 100 crores at least is there. Always a pleasure talking to you, Mr. Gautam. Thanks a lot for joining in and wishing us, and helping us out with all of those details. In fact, as we had your commentary coming in, your stock price as well has recovered from the low point of the day. So it seems the street is taking heart from all those statements that you just gave us. Let's turn our attention then from mattresses to the cement space. Mr. Anil Singhvi, the executive chairman at Sri Digvijay Cement, joins us to tell us about how the industry is shaping up and also give us a sense about the company that he is heading. Hi, Mr. Singhvi. Always good having you on the show. Thanks a lot for joining in. Let's talk about industry first. Are there signs that the cement industry is set for better times? There have been, patches of exuberance that have been displayed. But now do you think demand will continue to remain strong from here? Point number one. Point number two is pricing has been a disappointment. Have prices bottomed out?
Thank you for having me. My views are very simple. I don't think still we are seeing a good, robust demand in cement, which should have been there. I think we blamed earlier summer being hot, then we blamed monsoon being wet, and now perhaps we will blame the winter being cold. I think the seasonality, sometimes plays a role, but I think today we clearly see that there is not much of capital expenditure by government. So government spending is at a observably low, and private investments are not taking place. So I think cement is one industry I can speak for. I think we are still seeing a very struggling time. And let me dwell on the subject of cement demand. I think one has to look at the growth in cement, which includes the pricing as well. So I'll address your question in twofold. One is the demand per se. I think this year, 24-25, I will be pleasantly surprised if we have 3 to 4% growth, which also looks to me a daunting task. But when you look at the growth in cement, which includes the pricing, I think this will be perhaps one of the few years I have seen in 40 years where you're going to have a negative growth of cement.
Okay.
Because the prices are still 10% lower. So when looking at the demand point of view, demand 3-4%, but prices lower by 10%. So negative growth in cement by 5 to 6%, which is a huge cause of concern for not only for cement industry, for GDP growth as well. In fact, I read somewhere in this morning that moneycontrol.com saying that experts are now revisiting the second half numbers. Now, you can't have these so-called experts for the simple reason they got it so wrong in the first half. How do you again pin your hopes all on the second half and say that second half will be so good that it will recover for the first half? No, I think we have lost a big plot here. I think GDP growth itself should be, I'll be surprised if it crosses 6%.
Interesting, Mr. Singhvi, you're saying it as it is and how you see it, and there is hope out there. But as we know, hope is not a data point. You're giving us a data point. You're saying that the growth will be only 3 to around 4%. What about for your company? There was a bit of a degrowth that we have seen in the first half of the year, and the EBITDA per ton as well has come down. What should we be working with for the second half of the year? On your side, you've been using alternate power, green energy as well, and that's what's helped you all on the cost side. But if pricing is weak, then that puts pressure on the EBITDA per ton. So give us both those two numbers.
Yeah, I think we are still not seeing much of price increases, which should have come to cover up the last 7-8 months of low prices. So prices are still, a chase game. It's not reached to the level where we would have liked to see it in December, because now you're left with just about 3.5-4 months for this year. So I expect still the prices are, going to remain 5 to 7% lower than last year, which is making impact on the EBITDA margins and demand. I mean, pricing is again a factor of the demand, and demand is still playing very, very spoil sport. So I hope and pray, but I think we all seem to be living in hope, but I think something has to be done in terms of government spending. I was looking at some data that last 8 months, government spending is still just about 40% of what it should have been. And unless we accelerate that process in next 2.5 months, it's going to be a lost cause. And once Indian economy has this, and I've seen it enough time, I'm not an economist, but if you have a dip coming in, then to recover takes humongous time. So if it allows economy to drop at around 6% or lower than 6%, which this quarter had given, I think it's going to be a very, very challenging thing to go to 7-8%. And we all were expecting it to be 7-8% on a sustained growth basis. I don't think just making those announcements is going to make any sense to me. And cement is a barometer. Let me tell you that cement is a good barometer to judge which way we are going. Whether it's a poor man or a high rise in Bombay, what you see, cement is consumed by every single human being, be it repairing, be it extension, whatever it is there. Even if you make your roof, which is made of thatched situation to a cemented one, that shows the growth in the economy, that shows the prosperity. Yeah. So I think cement, and somewhere you see the GDP, you see the GST numbers. Cement, according to me, is the second largest contributor to the GST. And GST numbers net of refunds are not showing a very good growth here. So I think there is a bit of a. I think we need to really sit down as a in a country, as economists, as a government, to see why is that we are falling so badly this year.
Okay, all right. So for your company, should you end the year with flattish volumes, and EBITDA should be in that vicinity of what? Say we have some kind of improvement. So for the year, it should be in that vicinity of around 700-800 rupees.
I think we would have a marginal growth. I would still hope that next 2-3 months should be able to get us some growth. That's again hope and pray. And pricing, yeah, I mean, if we do about 700 rupees EBITDA, I think we should be lucky enough for this. This year has been one of the, according to me, this is one of the very surprising year. Let me use that word. So I'm disappointed, but very surprisingly on a negative side. Why, despite being, last 2-3 years having such a good growth, all of a sudden we have fallen from the cliff.
What about your expansion plans? You all had raised out that plan to increase cement capacity from around 1.2 around 3 million, as well as there would be some clinker addition as well. By when do we see this coming on stream?
This should be coming by March 25. So I think in about 2.5-3 months time. But again, my fingers are crossed because today we are not seeing much of a good demand coming up. So it will be quite a work to be done to sell almost double the quantity next year. So I think it's a challenging time.
All right, Mr. Singhvi, what about you? What is your stake in the company as of now? You had around 2.2%, which came down a little bit. You had some personal needs. Are you still holding stock?
Yes, of course.
But it's
it's
sub 1%, sir. So that's why we want to ask you, because a lot of viewers write to us. They are like, that Mr. Singhvi obviously has turned it on the company and it's done very, very well. But does he hold stock as of now? So do you hold stock? If you could clarify that, because it's below that 1%. And for us on the BSE, we can only see 1% plus. So if you could clarify.
Yes, I confirm that I own more than 1%.
So you cumulatively still own more than 1%?
Yes, as of today. Right. Yes.
As of today. All right. And you have no plans of selling more stake, from here on?
You asked me a question of what I hold today. I'm telling you today. I'm not an economist, not an astrologer.
Okay, all right. So 1% is what you hold. We take that. What about the promoter entity? There's a lot of consolidation that's taking place. And I've asked you this before as well. What's the PE's plans? You told us that the PE would like to hold on for a little bit longer. It's not like what it was in the past. Do they still have that sort of a mindset that they'll still wait for the capacity to come on stream and then, in fact, maybe scout for a new buyer?
As I mentioned to you in past as well, that it's been about 5 years plus. Obviously, most of the private equity firms have 5 to 7 year horizon. In this case, I mean, I can't speak for them. But looking at the current scenario on the industry, and we are looking at the expansion and all that, I think they would rather wait than to sell it today when the going is so bad in industry per se on that. So I still believe that they will see some more value coming into the stock.
Okay, all right. Final question then before we let you go, Mr. Singhvi. What about the industry? There has been a fair bit of consolidation. Pennar we never thought will happen. That happened. Kesoram has happened in the last year and a half or thereabouts. We have seen India Cements fold up as well, Orient Cement as well. Some more assets you expect to get folded up? Because for sure, I mean, you and me, we know that there are a couple of assets around the block. But are you expecting M&A action to continue in this fiscal as well? That's before March?
I think cement is one industry which is still very fragmented. So some consolidation may take place. I think it will be again depending upon the per ton capacity pricing, because when you look at the earning potential of the industry or the company which are in there, today they are in a lot of distress. So I think the activity which until about June, July looked very, very robust has slowed down for a simple reason that industry's growth, both in terms of price and in terms of volume, has tapered off very, very big way. So expectation of the buyer and the seller, I think the gap has widened since then. So I don't think it will be as accelerated as what we have seen in the last 6-8 months. But you can never say no.
Okay, all right. Well, thanks a lot for joining, Mr. Singhvi. You poured some cold water actually on optimism that we were hearing earlier today. You're saying that there has to be some action on ground. As of now, that's lacking. And hopefully things will pick up both on the demand as well as on the pricing front. Always a pleasure talking to you. Appreciate you speaking to us here on CNBC-TV18. Well, let's get a check on the markets. By the way, we were down close to around 100, 120 points or thereabouts, and that dip has got bought into. The Nifty has moved into the green. The mid-cap index is up close to around 100 points, and that's telling you the sentiment. You know, you have a lot of domestic money that's at play. So maybe the FIs continue to remain sellers, which in all probability will be the large cap names. But the mid-cap index seems to be having its mojo back. That's what we've seen for the last few sessions. Mitesh is back with us. Mitesh, what's your take? If you bought the morning dip or not?
We did not, but then again, the idea was that we were positive, so we were hunting in stock side. I think I still believe that the Nifty is well poised to retest 24,350. Only thing is that let the intraday indicator fire a strong buy. Till then, I think stocks can be traded on the positive side, and I have a buy on Info Edge or Naukri. That's a buy with a stop below 83.30 so about 100-point stop loss, but just 1.25%. It's 83.30 being the stop loss. Look for targets of 86.50 to about 8700 here. And Metropolis is the other one. That's a buy. Keep a stop below levels of 21.49. Look for targets of 22.60.
Okay, all right. Mitesh, got it. Thank you very much for that. We'll touch base with you during the course of the day. Let's see how things progress. Now, I need to take a break right now. We'll come back and talk commodities. Manisha will join in on the other side. Welcome back. Well, the equity markets are flip-flopping between green and red, and it's all about the GDP number. Let's see what's happening in commodities. What's keeping the international commodity markets excited this Monday? Manisha, good morning. You tell us, what are the headlines?
Well, last month of this year, and if you look at the agriculture commodities, well, that is where I'm putting focus on right now, because we just keep talking about non-agri all the time, but agriculture is a big space. Internationally, especially, you have big monies being made into this one, and the volumes are on the higher side as well. I'll start with edible oil space, and here we've seen some bit of a decline coming in. Soybean, for one, while, of course, in the month of November did see some gains, but flat on the larger side, has seen a 24% decline. If you look at the other edible oil prices, that pretty much has been the case. But for soybean especially, well, the prices have been on a downtrend for 2 years now. We've seen rise in global supplies. It also has to do with the fact that the prices have been on a downward trajectory since May 2022. And that is the time we saw 10-year highs in case of soybean there. I also want you to take you to other commodities. While wheat prices have seen a decline in this year, thank God for that, because one, you have higher supplies coming in. The global 2024-25 number for the international markets is looking higher at 79.3 million tons there. Take a look at the cotton prices, and it hasn't been a great year for cotton. One, you had higher supplies. Two, the demand wasn't so strong. The freight has been higher. It has been delayed movement of shipments as well, and all of that continued to weigh onto the markets there. And then when you talk about sugar, well, that has been another area where we've seen prices decline on a month-on-month basis, but for the year, 2.5% on the higher side. Brazil for 2024-25 is looking at a record crop, and that continues to keep the prices in check. Much of that speculative activity that we saw in the first half of the year for sugar also seems to be now getting out. And December is a month where you see a lot of books getting closed, trades getting unwinded. So that is the time that you could be looking at further declines, especially on this one. Well, that has been about losers, but these are the gainers, adding to the inflation in the market as well. So palm, for one, gained up by 7% for the month of November, 35% up. Well, palm is used in edible oils, as in sense of food, your cosmetics, your detergents, your pharmaceuticals, and we do know that the price rise has come in sense of soaps and shampoos. That is where palm also goes in. Sunflower has been on a higher side as well, 60% up in this year. We've seen rubber prices gain up by 25% as well. And if you look at the other commodities, well, coffee and cocoa should come back on your screens yet again, because the major run-up has actually come in for that. Coffee prices have gained up by 70% in this year, and cocoa is up by nearly 116% as well. Well, we have seen Brazil output continue to decline. Vietnam is another big one when it comes to coffee. There as well, we've seen output decline. Cocoa is a major crop in Ghana and Ivory Coast, and we have seen prices hit an all-time highs in this year into that one as well. So while essential commodities like wheat, rice, edible oil has seen a decline, but all your exclusive commodities, a bit of a luxury commodities, all have seen strong gains.
And now we know why our cafe mocha has gotten more and more expensive over the course of this year, and it doesn't look like there's any respite around the corner, Manisha. Thank you so much for that. All right, quick check on the markets before we take our next break. It's very, very flat. I mean, at the index level, not much is moving. In terms of the stock-specific action, the mid-cap market is holding on to about a 0.5% gain now, and the advance decline ratio, that's starting to climb towards the positive side of the screen. So that's the good news. By the way, watch out for some of the life insurers. HDFC Life is down 1.5%. SBI Life is also lower, but not too much. SBI Life is more like flat. Life insurers continue to reel under pressure. That was a big story last week. Aside of this, let's look at some more names. Dixon Tech, because of this Google Pixel tie-up, that's really turning out to be one of the stocks of the morning. About 5.5% up on that one particular name. 6% now. Dixon is up about 6.5%. It's a big, big move coming through. And look at Torrent Power. So mid caps and small caps is where the action is. I'm just taking some names as example. Torrent Power 6% higher, looking fairly good at this point in time. Let's take a quick break on that note. Come back on the other side. Our special segment, Citizens Monetary Policy, is going to be starting off. Lata will be in conversation with the CNBC-TV18 Monetary Policy Committee to discuss what the RBI MPC feels could be in the offing this Friday with respect to the RBI policy.